go. Welcome to the second quarter 2021 webinar. Dave Welty along with Lars Phillips. And we've got probably 35 minutes worth of, hopefully you find to be good content and educational information. And so with that, Lars, let's kick it off. How's that?
Beautiful. So as always, please feel free anytime throughout the webinar, if you have any questions, please feel free to type those questions in on the webinar side. We'll get to those at the end. We always have a section in the webinar for those last questions that you might have. So we'll just carry on. And Dave, I have to say, first webinar that we've done in person now together in
a long time.
A long time. I want to say 15 months, maybe.
Yes. I mean, so much so that you had to remind me, Dave, are you coming into the office for the webinar today? I hadn't planned on it, Lars. But here we are. We're back.
We're making it work. We're making it work. And I think this is also our first webinar with video camera in office. So good to see the big picture
and the new conference room.
And the new conference room.
A lot of news today.
Absolutely.
So. There we go. All right. Agenda. We try to keep it very consistent, predictable, do a quick economic update, investment review, Lars will take that, do a little bit of investor education on mostly focused around inflation. It seems to be on the top of everybody's mind. We'll give you our views on it. Tax updates, a couple things going on both in the state of Oregon and Washington I think people should be aware of, and then some fun housekeeping stuff. So.
Beautiful.
There we go, economic update.
Well, you take this one, Dave.
You know, this is just from March 31 through June 30th of this year. I would say that there's a few things that we'd like to point out. One of them that we didn't, stay right there, Lars. Oddly enough, if you look just to the left of that, you'll see Bitcoin falls as much as 30% as investors sour on cryptocurrencies. I think the latest number is from Bitcoin's high couple of months ago. It was up around 65,000. It's down around 30,000 now. So down over 50% as people start maybe having a better understanding of what crypto is, understanding what they really don't know about crypto and the volatility around crypto. It almost became a meme stock. So May 31st, oil prices hit a 2-year high as OPEC sees more demand. That doesn't surprise me, right? Lars and I were just joking earlier about how, a year ago you could get on the freeway and something that takes you 30 minutes today to get from A to B was taking you 12 or 14 minutes. Why? Because nobody was on the road, right? Yeah. Well, people are back on the road again. I mean, I have to leave earlier to go places now. What does that mean? People are driving their cars. What does it take to drive cars? For most cars, gasoline. Yeah. So there we go. It shouldn't surprise anybody. U.S. inflation is highest in 13 years as prices surged 5%. We are going to talk a lot more about this coming up, but it is something that I think is on the top of everybody's mind.
And tell you what, Dave, we're just getting a very quick update from one of our team members here. Give me 1 second. I apologize. This is just the classic working from the office, working from home. It looks like we may be showing the wrong screen. So tell you what, we're going to flip the screens here. Not a problem whatsoever. If you give me just 1 moment, we'll have everything up and running in just a second here. So the classic conundrum of the transition of working from home and in the office here. So here we go. Give me just 1 moment. I appreciate everybody's patience here. 1 second. We're going to view this. Here we go. There we go. Let's try this. And Dave, do you want to keep talking here for just a second, Dave, as we do get this all buttoned up?
Yeah, as long as this is what they're looking at.
Yeah. Here we go. Let's try this. And then let's try a full screen right there. Okay, I think that should be better. We will see. But tell you what, Dave, I'll let you keep talking here. I think that this should solve the issue, and perhaps if we do have any other issues, we'll have JP come and give us an update. So. Okay, we're getting the thumbs up. Thank you, JP.
I don't know what the problem was, Larson. We'll just leave it at that.
We'll leave it at that. That's easy.
There we go. So this is the last 1 year. Look, things have been great in the last 12 months. We were kind of joking this morning about client reviews in the last 3 months, 4 months, 5 months, 6 months, that everybody's really happy. Well, you're happy for a reason. One, again, the economies are opening back up. It's great. You're getting to spend time with family members again, friends again. Your portfolios are way up, but they're up for a reason. And the biggest reason is not because the markets are back. That's a piece of it. But the other component of that is that you kept your seatbelt on. You had a well thought out financial plan that didn't look for the next 90 days or 3 years or 5 years. You're looking way into the future. You kept your seatbelt on and you were able to ride back with the markets.
And I think in particular, it's easy to go into Orion, everybody's client portal, and you can actually go into activity and you can go back and see what has my performance been since March 24th of last year. And essentially, I like to say, Dave, that is your reward for having a long-term approach, for having that long-term outlook, for not freaking out when the market was at its bottom. And everybody is benefiting in a huge way because of that.
Sort of the high points here, Lars.
Dow eclipses 30,000 for the first time back at the end of last year. I think right now we're in that 33 range.
Yep.
Final day of last year, a new all-time high, and I want to say we've hit another 18 all-time highs this year alone, something along those lines.
Pretty close. Yep.
And end of June, again, markets continue to cruise to records in the first half. And I like to say, we can't control the markets. We always want to focus on what we can control. We know we can't control the markets, but we're certainly happy to see things move in the way that they have been moving. We're happy to be as diversified as we are, not only across just US stocks, but international, emerging, fixed income, and diversifiers.
Correct. There we go. And in the long term, look, this puts it back in perspective for over 20 years. I think everybody's been pretty happy the last 12 months, right?
Yep.
So it's been a good run.
Investment review, I'll take this. I don't want to say that this is boring because, it's never boring when the market's moving up. We're always happy about that. But again, at a quick glance, we can see in Q2 of this last year, US stocks up 8%, international developed up 5%, emerging up 5%, real estate up 10%. If you own a house, you're certainly seeing your real estate values jumping up in value. Bonds, they're holding their own. And again, the point of bonds in the portfolio is not to be the huge driver of return. The point of bonds in the portfolio is to really be that ballast to the ship. It's really to be that safe, more secure part of the portfolio. And bonds are doing just that. And I think in particular, the bonds that we hold, we made a small change to the bonds that we do hold here. I want to say towards the start of this year, particularly with that in mind. We don't want there to be a lot of volatility in our bonds. They're there for safety.
Yep.
So this is Q2. If we zoom out and we look at the 1, 5, and 10-year numbers, again, I don't want to say that these are boring because these are great numbers. On the 1-year basis, you certainly have to think about where were we a year ago. A lot of these performance numbers are simply a function of where we were a year ago. 5 years and 10 years, again, everything looks good, as we've talked about before, and we'll continue to talk about until we see a bit more of a reversion to the mean. But US stocks have certainly outperformed the likes of international and emerging. In our eyes, that's all the more reason, though, to invest in emerging markets and to invest in international developed companies, because things tend to do better when you start at a lower point. So from a valuation perspective, if we look at what the US has done compared to these other markets, well, the US is a little bit more expensive than emerging markets and international developed. So at least I know, like inside my Roth IRA, for those long-term dollars, I have a bit more emerging markets in that part of the portfolio, as do many of you when we think about asset location within accounts. But again, not a whole lot going on here. Very happy with returns. Very happy with
a lot of green arrows in the right direction.
A lot of green arrows, with the exception of US bonds, 1 year only down 1/3%. So very happy across the board here.
Now we're going to have some fun.
Now we get to have some fun. Yes, we do. Absolutely. So who wants to go? Should we rock, paper, scissors for this one?
No, look, I have been asked, I'd say 2 questions a lot. One, are you worried about the valuations of the US markets? They're expensive. Do I lose sleep over it? No, I don't. The economy seems to be coming back very strong. There's nothing that seems like there's this big headwind that's going to derail it. So hopefully earnings will keep up with prices, etc. But the other big topic that we get asked about a lot, that you hear about in the news a lot, right, is inflation, right? inflation is pretty hot right now. Most of you on this call have been through periods of time where you've seen it before. I mean, you go back into the mid to late 70s, holy mackerel, that was inflation.
If you wanted a mortgage back then, what were you paying interest rate wise?
12%, 13%.
Yeah.
You couldn't get gasoline. I remember I having a mini bike and waiting in line with people to get gasoline because it was being rationed at the time, et cetera, right? But inflation has definitely reared its head. But I think it's important to differentiate. Let's go to the next slide here for a second.
Absolutely, yep.
To differentiate, where are we seeing inflation, and what of what we're seeing today, what's going to be permanent and what's going to be transitory? In other words, what is short-term price adjustments? Before we talk about some of these individual like cars and used cars and gas and all that type of stuff, I think it's important to remember that the U.S. economy was humming along a year and a half ago. I mean, it was cranking, right? We didn't just slow the economy down. We shut the economy down in its tracks and came to a screeching halt, right? From huge amounts of demand to no demand, from big levels of production to no production, right? And the engines, they just weren't turned off and then waiting a day or two and then turning them on. I mean, the engine, this US economy came to a screeching halt, right? And it's really difficult to take an economy the size of the US economy and just flip the switch and get it going again. And we're seeing the impacts of what that really does to an economy. And I don't think anybody really fully understood how, well, first it was easy to switch it off, but how difficult it is to switch it back on with supply chain issues, people coming back to the workforce, all of these things. So Lars, why don't you talk about a few of these individual components of where we're seeing inflation?
Yeah, absolutely. So, and again, this really just says, you go on CNBC, you go on Market Watch, you're on your computer and you are hearing about inflation. It's clearly front and it's in the front of everybody's mind because it's being blasted across the media, which makes a lot of sense. And to your point, Dave, you think about where were we a year ago and where are we now, and how much of this is simply coming off of a low and how much of this is more permanent on a go-forward basis. So when we think about different parts of inflation, the used car market, this one has gone bonkers recently. And this is just me speaking from a little bit of experience. I was joking with the team here. I feel like I lost a little bit of who I am because forever and ever, for those of you that know, I have driven old kind of, I don't want to say beater cars.
Yes, you have.
There you go. I drove an 86 Volvo station wagon, and for the last 5 years, I've driven a 2001 Subaru Outback. Well, it's time for Lars Phillips to get a new car. And so I'm looking around, and ultimately, I finally decided on a new Subaru Outback. Well, why did I decide to buy new? Because I could have bought a 2017 Subaru Outback, and it would have cost me just as much as my 2022 Subaru Outback. From a financing perspective, it wouldn't have been nearly as good.
It was a no-brainer.
It was a total no-brainer, right? But you think about from an inflation perspective and from a shutdown perspective, cars these days require things like microchips. Well, when microchip factories get shut down and there's no demand for cars a year ago, well, all of a sudden to start back up again, that takes time. And so when I go out to negotiate for a car, I'm simply told by the dealership, we are not negotiating with anybody because you go to the car dealership and there's literally 4 cars on the lot, 3 cars on the lot. The car that I got was literally on the boat that morning in the port of Seattle, and I was driving it that night. These things are not staying because there is now so much demand and supply is so low that as a buyer, you have no negotiating power. Well, that then pushes to the used car market, because if you can't get a new car, what are you gonna do? You're gonna go buy a used 2001 Subaru Outback. If somebody wants my old car for a couple $100, let me know. But again, this is something that we would consider transitory. That is, once chip manufacturers are up and running again, once supply and demand can reach more of an equilibrium, we would expect that this is something that will not last forever. You're not going to be able to.
So in other words, Lars, what you're saying is on the far right side of that graph where that line is shooting straight up, it's probably not going to keep going straight up.
It'll probably come down a
It's
little
gonna
bit, or
probably
at
come
least
down.
level out a little bit.
My guess is it's
Absolutely.
coming down, Lars.
Yep.
As new cars
Yep.
come back into the, onto the lots,
Yep.
and you don't go there to buy a Chevy Tahoe, and we've got 3 to pick from.
Exactly.
And then all of a sudden you've got 20 to pick from, or 30 to pick from, or
Exactly.
50 to pick from.
A little more
And
negotiating
then
power.
a little negotiating power, and
Yep.
then suddenly also the used cars aren't in demand because people can buy new. Easier.
Exactly.
So, yes.
So again, that's a transitory example, something that we would expect would get through the system. So that's my kind of personal example. And then Dave, do you want to speak to maybe your
Here we
personal
go,
example?
right?
Here?
So Dave and his wife, Catherine, Mrs. Welty, we are going to be building a new home. And that's the theory anyway, right? So as we've been starting this process of designing a home and getting the costs, I was a little flabbergasted by the price per square foot. And, the builder quickly came back and said, look, prices have gone up in a number of areas. And as we all know, there's a lot of wood involved when you build a home, especially in the Northwest.
Yeah.
Well, lumber is usually tracked in what they call random board feet. I now know this, right? And the long-term number's always been in that $400 to $500 range for random board feet of lumber on the CBOE, the exchange. It spiked to $1,670 here in May. Well, who would have thought? I mean, I was pretty comfortable thinking that the price is going to come down because there's no way that line just keeps going up. And as I started to look into it, you can do some research and say, well, are there any logs to mill? Well, the mills are loaded with raw lumber.
Yeah.
Well, what's the problem? Well, you've got people that were home. They decided to do home improvement projects. There was nobody milling the raw lumber. Mm-hmm. Subsequently, you had this supply and demand whipsaw.
There was nobody building the houses for a brief period of time.
Well, actually, you know what? They're building homes, but all the remodel projects and the building of new homes and people realizing they wanted to move out of a city because now they could work remotely like we did, right? And so I think the price of like a piece of plywood that you'd use for sheeting went from $15 a board to $75 a board, right? Well, as of this morning, the random board length of lumber was back down to 600, right? And it's going to probably take us 3 to 6 months for those prices to work themselves into Home Depot and Lowe's and wherever else done lumber, wherever you buy your lumber. But I think it's going to it's clearly heading back down, right? So again, mills shut down. There was nobody to mill the lumber, to process the lumber. You had huge demand for it, even during the pandemic, which caused, these price disconnects, right? Well, eventually we're going to have a bunch of lumber, and we're probably not going to have people doing home projects to the extent they were doing. So I'm hoping that my timing is actually phenomenal, Lars.
Fingers crossed for you.
I was nervous for a while, and now I'm feeling pretty good.
Yeah.
So here we go. Transitory.
Yep.
Transitory.
Probably go away.
Supply and demand.
Yeah.
Supply and demand. What's more permanent?
So we think about things that are permanent, like, in this example, Procter & Gamble, they basically came out and said that they're going to raise prices on baby care items. General Mills just came out and said, essentially, if you want to buy a bowl of cereal or a box of cereal, prices are going up by about 7%. And these are things that we would not expect to go back down.
Yes.
And the reason for that is that these are more permanent items. And you think about things like wages tend to be a bit more permanent. You think about things like commodities that are not as transitory as lumber, they tend to be a little bit more permanent. It's the same reason why a burger today costs more than a burger 20 years ago, 40 years ago, 60 years ago. Things get more expensive over time.
But here's the tricky one. You're talking about General Mills, right?
Yes, yes.
So one of the things that some of the companies are doing to try to trick you, to make you believe that there is no inflation. So the box of cereal that you paid $2.49 for, I'm throwing that number out.
It was 20 ounces of cereal.
20 ounces.
Yep.
Now it's the same price, but it's 17.8 ounces. They've changed the size of the box. The logo is the same. You don't know it, but your price for that box of cereal has gone up. I think they call it.
Do you know the term? Shrinkflation.
Shrinkflation. There we go.
Yeah. So you're paying the same price, but you're not getting as much.
Yeah. So I'd rather pay a little bit more knowing what I'm getting personally.
Absolutely.
Like our next example,
Yep.
the burrito, right?
They're not shrinking your burrito here.
You know, Chipotle has just hiked the price on their burritos by 4%. The volume in the burrito is staying the same.
Absolutely.
Right? But it has mostly to do with our hourly wages, right? Wages are going up, and you know, you can argue it's good, bad, or indifferent. But the fact of the matter is, in the greater Puget Sound area, it's $15 an hour. And if you're only paying $10 an hour in an area outside of, you know, where it's mandated it's 15, you're probably not going to get people to come work for you,
Yep.
right? Your wages have to go up under the circumstances that we find ourselves in. So the question becomes, is that once you give people a wage increase, do you ever take it away?
Sticky.
No, you fire the person if you don't like them, right? But so the price of the burrito is probably here to stay. The good news is the amount of beans, rice, the cheese, the pico de gallo is probably consistent, right? So this is permanent, in my opinion. And by the way, the disclaimer, a master's in economics from any business school?
Say that one more time. Do I have a master's in economics? No, I do not.
Or a PhD?
I do not, no.
Neither do I,
No.
right? These are our opinions. The other good thing about this, or we're talking about from an inflation perspective, is we could actually get 10 economists in this room with us, and they would all disagree to some degree on all the things we've just presented, right? So.
From an inflation perspective, I think a lot of people might have the question as to, well, what are you doing about this in our portfolio? And within the Avier portfolios, as you guys know, you can log on to your client portal, you can log into Orion. And if you look at the aggregate portfolio, you're going to see a few different sections. There's going to be domestic, international, and emerging market stocks. There's going to be fixed income, and those are the components that we talked about earlier, being those safer, more secure assets, the ballast to the portfolio. But then you also hold what we call our diversifiers. And a phrase that we like to use for diversifiers, in fact, are stealth inflation fighters. Now, the four main diversifier funds that we hold, we just listed them right here. We have the Vanguard Inflation Protected Securities Fund.
No, wait a minute, Lars, that name isn't stealth.
That is not stealth. That's exactly what I was going to say. This one, there's nothing hidden about this. This is directly tied to inflation, right? The other pieces are a little bit more stealth. So we think about emerging market debt opportunity funds. So this is essentially emerging market bonds. Well, think about this. If we have inflation inside the US and the US dollar then depreciates compared to the rest of the world, if you hold bonds or fixed income in foreign denominated assets, so you hold, Japanese yen bonds, you hold, bonds from Mexico, Brazil, Russia, India, China, you name it, Malaysia, Peru.
How about not Russia?
How about not Russia? We can look and see if there is any sort of Russian exposure. If there is, it's very, very, very small. But long story short, inflation in the US leads to a depreciating dollar, which means that if you hold foreign denominated currencies, that is essentially a tailwind to the investment. So if the underlying bonds, which their yields tend to be a little bit higher than the US, but let's just say that the bonds are yielding 4 or 5%, if we see inflation inside the US, you might end up with a return of, and again, this is just all hypothetical, obviously, but you might end up with a return that is higher than that 4 or 5% yield because of the tailwind of inflation in the US.
And keep in mind that when you think of inflation and you think of debt, it's not just the price. Why do the prices increase? A lot of times it's because the value of the dollar has depreciated, right? So there we go.
The two other pieces, DFA Global Real Estate. I think it's no surprise to anybody that if you go on Zillow and you look at your house today, you're going to see that that value is probably a lot higher than it was a year ago. And so we think about, from an inflationary perspective, as we see inflation, we would expect that real estate would move up with inflation. And then the last piece, the JP Morgan Chase Alarian ETN, that's AMJ within client portfolios. And again, AMJ is really going to be tied to commodities. It had a pretty rough run at the start of last year, but it's been on a tear since then. You look at the price of oil, you look at what you're paying for gasoline. Obviously, gas costs a lot more right now than it did a year ago. A lot of that's supply and demand. But again, when we think about commodities as inflation comes into play, we would expect things to cost more, like commodities, like gas. And so again, more of a stealth inflation fighter within your portfolio. So
Hey, Lars, can you just touch on the whole thing of it's better to be lucky than good?
yeah, absolutely. So as many of you guys know, we had sent out an email about this and we spoke about this during one of our earlier webinars. We said, hey, we're going to be making some small adjustments to our overall diversifier portfolio. We have always held, or at least for the last number of years, we've held this AMJ position, but rather than holding a global real estate position, rather than holding the inflation protected security position, we held the PIMCO All Asset Fund, which essentially encompasses a lot of these positions.
Which some clients still own because of
From a tax perspective, absolutely.
Yeah, the tax bill that would have been paid by liquidating.
Exactly. So yeah, some of you may still hold that, but for the most part, we said, what we want to do is take that position, break that position apart into more of its component parts, and put a little bigger focus, one, on inflation, and two, just on reducing costs, but having the same underlying exposure. We did that on March 30th. And so for all intents and purposes, come April 1st, we were invested in these funds that we're looking at right here. What's happened since then? Again,
the timing has been spectacular.
The timing was spectacular. Did we try to time the market? Did we say, well, we really see inflation really kicking into gear here in the next 3 months? Absolutely not. These are long-term holdings that we expect to hold for years and years to come. As you guys know on the call, we are not jumping in and out of markets. We don't have CNBC on in the background and saying, oh, well, China's down today or this part of the market's up tomorrow. None of that stuff. These are long-term positions, and again, our timing just happened to be pretty good.
Perfect. We'll take it.
We'll take it. Let's carry on. See what else we have here. Tax updates.
Oh, here we go. Now you're going to get me.
These aren't quite as fun as some of the other pieces.
So this is more of a, this could actually be taxes update, Washington State Public Service announcement. Mm-hmm. So if you are working, not if you're retired, collecting money or taking distributions out of an IRA or investment income, but you are working, you're a W-2 employee.
In the state of Washington.
In the state of Washington. Yep. The Washington State Long-Term Care Act will go into effect on January 1 of next year. They are going to start taxing your wages 0.58%, or we say 58 basis points.
And that's wages, that's restricted stock units that are vesting, that's bonuses,
bonuses,
all
the whole enchilada.
Yeah.
The bummer is that there's no limit on the compensation. So if you make $100 grand, you're going to pay $580 for this long-term care policy, which I'm going to tell you, I think is pretty. I'm going to bite my lip. I don't think it's very good. How's that? Maximum lifetime benefit of $36,500. Holy mackerel, right? What if you're making $500 grand? You're going to pay $2,900 a year for that benefit. Look, so what we have done is we've sent out a number of educational pieces to our clients. Most of you, I hope you've seen them, because even if it doesn't affect you, you may have some of your siblings, children, a friend next door. Most people don't know this is happening to them, right? And so what we've all done here at Avier is we went out and we're getting private long-term care policies, and you've got to get one in place. And you have an opt-out period one time only between October 1st and 12/31. To put it in perspective, I'm 60, I'm in pretty good health. To get a benefit that the state would recognize to allow me to opt out is costing me less than $400 a year.
And chiming in, I am in my 30s, healthy. It's going to cost me, I think, $16 a month or $180 per year. And I promise you that I would be paying a lot more than that if I did not opt out.
And I would be paying a lot more than that had I not opted out.
And can I chime in with one other thing here, Dave? So when we think about getting a private policy, for the most part, we're recommending that folks go out and get the most bare bones policy that they can in order to opt out of the state.
To qualify
to opt out. Now, insurance companies are being overrun right now with people that are looking to do just that, to the point where there are a number of insurance companies that are saying, we're not going to offer plans to anybody who is under 30. We're not going to offer plans to anybody under 40. And then what insurance companies are doing, and this really grinds my gears. If you want to get me going, just bring this up. they're seeing this as an opportunity to sell insurance policies that are super expensive,
that people typically don't need.
that they don't need, that then just have a long-term care rider associated with it. So we've seen folks that are being offered policies that are $500 a month. Oh, but it has a long-term care rider on it. These are people that should be paying $500 a year.
And it's not that long-term care insurance is bad. It is appropriate for a number of people. But a lot of our clients are self-insured. They don't need it. So anyway, if you want more information on this, reach out to us. There's also a blog that Nick Wright wrote. That
Really
I think
good
is
blog.
Really well done.
Really well done.
We're here to help you, okay? So.
Next piece, in the state of Oregon. So obviously Oregon has state taxes. There's been a number of policies proposed particularly in the Portland area. Additional 1.5% preschool tax, 1% affordable housing tax on income above 125 for single filers, 200 for families, and then for income for single filers above 250 and for families above 400, additional tax on top of that, to the point where Portland and Multnomah County are becoming, from a combined state and local tax perspective, one of the most expensive areas in the entire country to live. Alex Kreider, colleague, put out, again, a spectacular article about that. So just go to our blog, check that out. I think it's the most recent blog that we have. Kudos to Alex, really well put together. If you do have questions about this, please reach out to Alex, reach out to members of your team.
And I want to stress, I'm not, and I don't think Lars is either, saying that these taxes that are proposed to come down the road are good, bad, or indifferent, right? That's not the point. Our job at Avier, as these partners in this long-term process with each and every one of you, is to say, look, we should all pay our fair share of taxes, but no more than that, right? And so, we look really hard to make sure that we locate assets in the right area so that we can mitigate these taxes to the extent we can while playing 100% by the rules, right? And so this is, as much of anything, this could be another public service announcement of, look, be aware of it, right? And then make decisions for you and your family that are appropriate based on the information that you now know.
And Dave, I think you were saying earlier when we were talking that in the scheme of things, the investment management side of things, that's the easy side of things.
Yeah.
When we talk about the more difficult, more planning-oriented items, it's stuff like, what can you do to opt out of taxes if given the opportunity to? Are you taking advantage of all the benefits available to you at your employer? Are we locating assets in the right
playing
direction?
100% by the rules?
Absolutely. Absolutely.
So.
Next up, again, if you guys do have any questions, please feel free to use that sidebar. I see a number of questions either have come in already, or some of you were probably saying, hey, I think you're showing us the wrong screen, which I'm sure we'll see those here in just a second. So,
and by the way, that wasn't my fault.
I will fall on the sword on that one. But again, appreciate everybody's patience with us as we kind of transition back.
It probably would have been better for me to take it because they would have expected it.
I know, but they wouldn't have expected that you were setting up anything computer-wise. So
there we go.
They would have seen right through that. Housekeeping and wrap up, a few really good items here. So cybersecurity, this is a really important one. This is a big one. So if we just zoom out a little bit, obviously right now, we are continuing to work from home where given the opportunity and where it makes sense. And we're doing some meetings here in the office, and we'll talk a little bit more about that in a second. But as a part of that process, every single Avier employee now has their own work-specific laptop. Now, on that laptop, we have all kinds of protection, and we're actually working with an outside essentially consulting service.
IT consulting service.
IT consulting service to make sure that we have firewall protection, cloud-to-cloud backup, security software is installed on all of the computers.
And it's not just a one-time here and there. It's ongoing. It's an ongoing where they actually have access to the laptops that we're using to monitor, make sure things are as up to date as humanly possible.
If anything were to happen and we needed to wipe that laptop out, we have the ability to do that.
Yep.
The other nice thing is the fact that because we are now cloud-based, and we've essentially now gone 100% cloud-based, which is really nice because it means that for one, it gives us the flexibility to work from home and have all of the information that we need. But two, from a security standpoint, we no longer have a server in the back of the office that stores all of our stuff. So from a physical security perspective, a huge step up in that direction as well. So really, really happy about that. I know that we had a few questions about what are we doing. And then the other thing that people have had questions about is just multi-factor authentication. Clearly, with any system that we're logging into, I've got my phone on me at all times, and the reason for that is because whenever I need to log in to really any system, I need to prove that I am myself, and that's either going to be a text message reminder or code, I should say, or it's going to be a multi-factor authentication app. I think that this is something that we've all grown accustomed to, but certainly helps from a cybersecurity perspective.
And keep in mind that you're a client of Avier, your money's custodied, TD, Schwab, or Fidelity, right? And frankly, we rely on them to provide best-in-class cybersecurity
Absolutely.
Protocols, right? Orion, where we aggregate, we've got to do multi-factor authentication. Salesforce, multi-factor authentication. So we are being as proactive as we can possibly be in this area. And we just made huge changes with going to the cloud. We're not going to sit back and say, oh, good, we're happy now with it. No, it's going to be an ongoing journey as more and more, as more opportunities present themselves for us to get better, we're going to do that. So.
Back to the office. So as you can see right now, Dave and I in the same room, fully vaccinated, excited to be here. With that being said, also excited to keep working from home. Yeah. It's been really, really nice. I joke with Dave that, don't get me wrong, love being in the office, and there's stuff that we can do in the office that we can't do from home. But I also really enjoy the 15-second commute to my basement. And frankly, we've gotten really good at that sort of remote work. And I think that everybody on this call has probably experienced that, whether it's account reviews that we've done with you, whether it's questions you have, quick one-offs. It's easy for us to do what we do while working at home. We're incredibly connected. We've got meetings every morning as a team. But we just wanted to point out that, again, this is a gradual transition. So we are not in the office 5 days a week by any means. And we do want to maintain that flexibility for both employees who also really enjoy working from home, but also for you, the client, because
just one thing though, so you're not in the office 5 days a week, I'm not, but there's always people in the office 5 days a week. It's just who's here and who's not.
Exactly. And we want to give you guys that flexibility because we don't want to force somebody who lives in, Maple Valley, or we don't want to force somebody who lives in Tacoma, or we don't want to force somebody who lives in Tigard to come all the way to whether it's Bellevue or Lake Oswego to meet us in person. And again, we've gotten really good at this. So to the extent, I would say forever and always going forward, whether we are in the office or not, if you would prefer not to make the drive to the office, we can still have really, really productive meetings. So always want to give you that flexibility. Clearly, if you do want to meet in the office, we can certainly make that work.
And I would say it's one of the real positives of the pandemic, right? It forced us we're a very tech forward firm anyway, but to push it above and beyond that, right? And we've gotten comfortable with it. We've gotten very good at it. And so we want to make sure we create that same flexibility that you've grown accustomed to over the last, 16, 18 months. You want to come in, great, virtual, because from a time savings perspective, we'll give you that flexibility.
Make it happen.
So, make it happen.
The next couple of slides here, these are some of my favorite. Dave, I'll let you take this one here.
So we're growing. We continue to grow, as you'll see on the next slide. But the most recent addition to our firm is Pasong. Pasong joined Avier as a client service associate along with Sarah Miller, right, to support the 3-person advisory teams. Pasong, born and raised in Nepal, moved to the U.S. to pursue a bachelor's degree. Recently graduated from Marymount University with a degree in finance, lived in DC for the past 4 years. We are absolutely 100% delighted to have Pasong on the team. Pasong had a lot of options on where he could go, heavily recruited, and he chose Avier.
Moved across the country.
We are we're super excited to have Pasong on board. He started 2 weeks ago?
3 weeks ago.
And he can dunk a basketball, which I can't do.
So Dave, when I saw this slide put together, I looked at this and I said, Pasong, you can dunk a basketball? You gotta be kidding me. Because, I'm a little taller than Pasong. He's not a short guy by any means, but I'm a little taller. I thought, this guy has hops. And Pasong said, well, and maybe I shouldn't give away the secret, but he goes, yeah, Lars, that's an 8-foot hoop right there. So,
but here's the thing, I couldn't dunk on an 8-foot hoop.
There you go. Absolutely. So thrilled to have Pasong on board.
So there we go. We're again super happy to have Pasong. Just part of this continued growth at Avier, right? And we are recruiting the best of the best. I think the next slide's going to show, I mean, that's the team now, right? I mean, it's just, every once in a while, when Lars showed me this slide this morning, I just went, holy mackerel, right? I think we have 7 advisors with CFP designations. Meow gets to use hers here, I think, in a couple months, which would be 8. We have 4 advisors with chartered financial analyst. You don't say designation, CFA charter holder.
CFA charter holder.
God, I don't want to get in sideways with the CFA board.
No, don't get sideways.
Here's the cool thing. You'll see on the bottom right, coming soon, we've already got another gentleman who starts Tuesday.
Yeah.
But we can't put him on here yet for compliance reasons.
3 or 4 days he'll be with us. Absolutely.
Yes, joining the Lake Oswego office.
Yep.
We've also got another lead advisor where we're super excited about joining September 6th or 7th.
Spending the summer with her kids.
Spending the summer with her kids. Asked if she could do that. And I was, you guys know I'm family first. I said, absolutely. Had been at one firm for 13 years. When you see the profile, you'll see, we'll probably put up the picture of her gracing the
Financial Planning Magazine.
Yeah, the cover of Financial Planning Magazine.
We landed a big fish, I would say. Let's put it that way. And we're very excited.
We're super excited.
Very
right?
excited.
And then on top of this, we've actually have our next hire after that, which will take place January 4th or 5th, already in the books. Another client service associate that we're super excited about. So we're growing, wonderful group of individuals. We're here to help you, serve you in any way we can. But I'm really proud of this group of individuals.
And I would say, before we move on to the next slide, let's just give kudos where kudos are due for the entire presentation here today.
Oh,
Dave,
yeah.
I know you and I did not do a whole lot of work on this presentation. We get to present, but we don't do a lot of the behind the scenes work. So a huge kudos to Meow, who did a great job putting together
all the heavy lifting.
All the heavy lifting, and Chris did a lot of the work as well, and just the entire team.
Everybody contributes, but Meow drove the bus. Chris was the co-pilot on the bus.
Yeah.
I was in the very back of the bus.
JP approved them from a compliance perspective.
It's a team effort, but anyway.
And just also very quick, Dave, do you want to speak to the interns that we have right now? Because I know that we have not really formally introduced them, but they're doing some spectacular work for us.
Yeah, so AJ here on the right does a lot of data analytics for us, does some writing for us. Wonderful young man at Seattle Pacific University. Happy to have him on board. Always interesting. And then we have Caitlin who's also at SPU. Caitlin's a double major, getting a degree in economics and marketing. Is that right?
I don't know.
Finance and marketing?
Well, that's my combo. That's a good.
Finance and marketing. Double major at SPU.
Yeah.
As you know, or if you don't know, we do a lot of video production. We do a lot of 2, 3, 4 minute videos that are all educational in nature for folks at Microsoft, Amazon, Intel, Nike, VMware, the list goes on. Pretty cool number, Lars. We're now getting 10,000 views a month on our YouTube channel, right? In the past, we would do these short videos. We'd hand it over to Alex Castmate and say, Alex, can you get this done for us? The editing. He'd get it done, but it was always a 1 or 2 or 3 week lag. And now we give it to Caitlin, who does a spectacular job with that, turns around in 24, 48 hours. So I always joke with other advisory firms who are reaching out to us to say, what are you guys doing? Why is your marketing working so well? How have you built out this really cool team of individuals? I believe that our interns, Caitlin and AJ, are our secret weapons at Avier, right? Why more people don't do this? I don't know. I was just talking to a good friend yesterday whose son, I was asking how the kids were doing. He goes, oh, well, so-and-so's got an intern at Marriott. That's super cool. He goes, yeah, it sounds super cool. He's stocking the breakfast bar at Marriott, but he can put that he worked for Marriott for the summer on his deal.
Yeah.
Our interns actually contribute every single day to the team. And so we're super happy and proud of them. And the work that they bring is very beneficial. So.
And just a few other very quick items here before we get to questions. We are also super excited to have our new website redone. I'm sure that you guys have all seen that at this point, but just a reminder, you go up, you click on login, you go to account access. It's the same logins that you've seen before. So TD Ameritrade, Schwab, Fidelity, Orion for your client portal. It's all there. It's all good stuff. So very happy about the website adjustment.
And again, kudos to Chris.
Huge kudos to Chris, who worked on this thing for months, and I am thrilled with the result. And we've gotten a lot of positive feedback from clients on this as well. So feel free to pal around there, and then while you're there, we have a few other ways that you can connect with us. So we are on LinkedIn. We'd love to connect, not only to connect with with the Avier page, but just connect with your advisor, connect with your team. We try to post a lot of good content there. Facebook, we do have a Facebook page as well. Feel free to connect with Avier on Facebook. And then the bigger one, to Dave's point, is on YouTube. We put out a lot of really cool content, and I think right now we have something like 770 subscribers. We're making that push for 1,000. We're going to get there before the end of the year, but to the extent that you want to subscribe to us on YouTube, we would really, really appreciate it. And I think as a part of the follow-up just to this webinar, you'll see a link.
There'll be a link there.
There will be a link. So again, you'll see all the content that we put out. It's a lot of really high quality content. And even if it doesn't relate to you, maybe you know somebody who works at Microsoft or Amazon or Intel or whatever it might be.
Good stuff.
Lastly, after this, I believe that you will receive a survey. We always love feedback. We try and integrate that into the presentations that we give. So know that we read every single line of feedback that you guys provide for us, and we certainly love that feedback. So please keep that coming. Questions. Let's see how many questions say, hey, we're seeing the wrong screen here. It'll take just a second to pull up here. Okay, number one, we are seeing the presenter view. That was from Alex Castaneda. So thank you, Alex, for that. Appreciate that. It's good to see the two of you again. Thank you very much. Always appreciate your positive words there. Next one, for the Washington State long-term care, is there no ability? Give me 1 second. We're going to expand. We're going to expand this on our side.
To self-insure, and the answer is no. You have to go out and get a policy. You have to go out and get a policy. Okay.
Yep.
The window is short to opt out. If you don't opt out, you are stuck. All right.
The next one says your slide showed the opt-out date for long-term care was October 21st through December 2022. Well, that should have been 2021. So thank you very much. Yes, that is
more than a year.
It is just a 3-month time period. Thank you very much for catching that.
Yes.
Should have said until January. Yes.
And on the follow-up email that we send out, we'll make sure we
denote that.
Yeah.
Easy.
Good.
Easy.
Awesome.
The next one, meaning self-insurance isn't a viable reason for opting out. That is correct.
That is correct.
Absolutely. So.
Yeah. And the individual that asked this is off the webinar, so we'll make sure that we personally follow up though.
Absolutely.
To make sure.
Fewer questions than we usually have. I guess we've answered all the questions. Really and truly, if anybody has any last minute questions, feel free to type those in there on the sidebar. But otherwise, hey. Again, really appreciate it. This is time well spent. We always appreciate everybody who's managed to join us for these things. I think that we're looking at, something like 40 plus attendees. So thank you to everybody who's joined us. In terms of the next webinar, we're looking at October 28th at 11 a.m. Dave, you said there's a chance you may not be on that one. I might be riding solo or with another advisor here in the firm.
We're not giving you solo, Lars.
We'll bring somebody else in.
We'll bring a pinch hitter. Maybe we'll get Nick
join
involved.
us. Maybe bring Angela in if she's around.
Exactly. Or a combination.
Absolutely. I like it.
Here we go.
So.
Beautiful. Thank you, everybody.
Yep.
We appreciate you. That's all I'm going to say. We appreciate you.
Thanks for everything. Another good quarter. We hope it continues, and thank you for joining us. Really appreciate everybody's time. Time well spent. We'll see you soon.
Thanks. Bye.